They knew. They always know. Now, while you were checking your portfolio last month, celebrating those gains, the big players were already gone. Institutions don't panic sell during crashes. They exit months before you even see the warning signs. This is the exit playbook. And if you don't understand how they leave, you'll be left holding the bag every single time. Welcome to the silent collapse, where we expose the moves they don't want you to see. Before we dive deep into this, do me a favor, hit that like button right now and subscribe to this channel. What I'm about to reveal could save your portfolio from complete destruction. The information you're about to hear is based on actual institutional patterns, leaked trading data, and insider movements that Wall Street desperately tries to hide. So smash that subscribe button because this channel is dedicated to showing you the truth behind every market move. Let me start with something that should terrify you. In September 2021, months before the massive market correction of 2022, hedge funds and institutional investors began quietly reducing their positions. The S&P 500 was still climbing. Retail investors were euphoric. Crypto was hitting all-time highs. And yet, smart money was walking toward the exit. How do I know this? Securities and Exchange Commission filings. These documents, released quarterly, show exactly what institutions are buying and selling. And in late 2021, the pattern was unmistakable. They were selling. But here's the thing. They don't just sell everything at once. That would crash the market and destroy their own exit. Instead, they use a carefully orchestrated playbook. They trim positions slowly. They shift from growth stocks to defensive sectors. They increase cash positions. They buy puts as insurance. And most importantly, they stay silent. No headlines, no warnings. Just quiet, calculated exits while analysts on television tell you everything is fine. The first rule of the exit playbook is distribution. This is when institutions begin offloading their shares to retail investors. You know those days when the market gaps up at open, everyone gets excited, but then it slowly bleeds throughout the day? That's distribution. Institutions are selling into your buying. They're using your enthusiasm as their exit liquidity. The volume is high, which looks healthy, but it's actually them transferring their bags to you. I want you to understand something critical. Institutions have access to data you will never see. They have order flow data. They know where retail stop losses are clustered. They see real-time capital flows between sectors. They have direct lines to corporate executives. They employ entire teams of economists, analysts, and quants whose only job is to predict market turns. When they start moving, it's not a guess. It's calculated. Let me give you a concrete example. In early 2020, before the COVID crash, several major hedge funds dramatically increased their put positions on the S&P 500. This was not public knowledge at the time, but filings later revealed it. These weren't small bets either. We're talking hundreds of millions of dollars in downside protection. And this happened in January and February, before the virus was even considered a major threat by the mainstream media. They knew something was coming. They positioned accordingly. And when the crash happened in March, they made fortunes, while retail investors lost everything. Now let's talk about insider leaks, because this is where things get really disturbing. Corporate insiders, the CEOs, CFOs, and board members are required to report their stock transactions. And guess what? They sell at the top, every single time. In 2021, insider selling reached record levels. Jeff Bezos sold billions in Amazon stock. Mark Zuckerberg sold massive amounts of Meta. Executives across dozens of major companies were liquidating shares at unprecedented rates. Were they all just coincidentally needing cash for personal reasons? Or did they know their stock prices were overvalued and due for a correction? The data doesn't lie. According to reports from financial research firms, insider selling in 2021 hit levels not seen since 2007, right before the financial crisis. That should have been a screaming alarm for anyone paying attention, but the mainstream financial media barely covered it. Why? Because their job isn't to warn you. Their job is to keep you invested, keep you trading, keep you generating fees for the system. Here's another piece of the playbook. Institutions rotate into defensive sectors before crashes. What does that mean? It means they sell high-growth technology stocks and buy utilities, consumer staples, and healthcare. These are sectors that perform relatively well during economic downturns. If you monitor institutional holdings through 13F filings, you can actually see this rotation happening in real time. In late 2021 and early 2022, there was a massive shift from tech to defensives. The smart money was preparing for impact. But the most insidious part of the exit playbook is the narrative control. While institutions are selling, they're also pumping the market through media channels. Analysts raise price targets. News networks run segments about new all-time highs. Investment banks publish optimistic forecasts. And retail investors, trusting these sources, keep buying. This is coordinated. It has to be. Because if everyone tried to exit at once, there would be no liquidity. They need you to be the buyer while they are the seller. One of the most blatant forms of manipulation is painting the tape. This is when institutions place large orders to create the illusion of buying or selling pressure, then cancel those orders before execution. It tricks algorithms and retail traders into making decisions based on false signals. High-frequency trading firms do this thousands of times per second. It's technically illegal, but enforcement is a joke. By the time regulators catch on, the profits have been made and the traders have moved on to the next scheme. There's also the issue of access. Institutions have direct market access. They can execute trades in microseconds. You, as a retail trader, go through brokers who route your orders through payment for order flow arrangements. Your order gets sold to market makers who can see it before it hits the exchange. They can trade against you, front-run you, and profit from your transaction. You're operating with a built-in disadvantage, and most people don't even realize it. Here's something that should make you angry. During the 2020 COVID crash, while millions of Americans were losing their jobs and watching their retirement accounts evaporate, some hedge funds made billions. How? They had positioned for the crash weeks in advance. They bought puts, they shorted specific sectors, they knew the economic damage would be catastrophic, and they bet accordingly. And when the Fed stepped in with trillions in stimulus, these same funds were perfectly positioned to ride the recovery. They made money on the way down and on the way up, while the average person just tried to survive. This brings me to an uncomfortable truth. The market is not designed for you to win. It's designed to transfer wealth from the uninformed to the informed, from the slow to the fast, from the emotional to the calculated. Every rally is an opportunity for institutions to sell to you. Every crash is an opportunity for them to buy from you at distressed prices. You're not a participant. You are the product. Your capital is what they extract. So what do you do with this information? How do you protect yourself when the game is rigged? First, you follow the smart money, monitor 13F filings religiously, watch insider transactions, pay attention to institutional cash levels. When they start exiting, you exit. Don't wait for the crash. Don't listen to the talking heads on financial television telling you to buy the dip. Follow the money, not the noise. Second, understand that markets are cyclical. There is always a boom and always a bust. We've had over a decade of central bank intervention propping up asset prices. No, that's not normal. That's not sustainable. And when the music stops, the correction will be severe. Position yourself defensively. Hold cash. Buy assets that hold value during downturns. Don't be over-leveraged. Don't assume the party will last forever. Third, recognize the signs. Extreme valuations. Euphoric sentiment. Record insider selling. Institutional rotation to defensives. Fed tightening. These are not subtle clues. They're blazing red flags. And when you see them all at once, which we have recently, you need to act. The institutions won't warn you. The media won't warn you. You have to be vigilant and willing to make unpopular decisions. Let me share one more historical example to drive this home. In 1999 and early 2000, right before the dot-com crash, insider selling reached historic levels. Warren Buffett, who is not an insider but is certainly smart money, refused to invest in tech stocks at those valuations. He was mocked for being out of touch. The media called him washed up. And then the market crashed, erasing trillions in wealth. Buffett was proven right. The insiders who sold were proven right, and the retail investors who bought at the top lost everything. The same thing happened in 2007. Home prices were soaring. Mortgage-backed securities were rated AAA. Everyone was getting rich in real estate, and insiders at the biggest banks were quietly selling their shares. John Paulson, a hedge fund manager, bet billions against the housing market. Michael Burry did the same. They were called crazy. They were ridiculed. And then they were proven spectacularly right. They made fortunes while the global economy collapsed. They saw what the institutions were doing and positioned accordingly. This is the reality of financial markets. There are those who see the exits, and there are those who get trampled in the rush. The institutions, the insiders, the smart money, they have every advantage. They have information, access, resources, and most importantly, discipline. They don't get emotional. They don't fall in love with positions. They execute their playbook ruthlessly and without hesitation. Right now, if you're paying attention, you can see the setup. Valuations in many sectors are stretched. Corporate earnings are under pressure. Consumer debt is at record highs. The yield curve has been inverted, which historically predicts recession. Geopolitical tensions are escalating. And through all of this, institutions are quietly adjusting their exposure. They're selling growth, they're buying bonds, they're raising cash, they're preparing for what comes next. And what comes next, if history is any guide, is not going to be pleasant. We're likely facing a significant market correction, possibly a recession, maybe something worse. The everything bubble, inflated by years of zero interest rates and quantitative easing, is deflating. And when bubbles pop, they don't do it slowly. They do it violently. Fortunes are wiped out. Lives are destroyed. And the people who saw it coming, who positioned correctly, they emerge stronger and wealthier. You have a choice. You can ignore the warning signs. You can trust the institutions that have deceived you time and time again. You can believe the narratives pumped through mainstream media. Or you can educate yourself. You can follow the smart money. You can prepare. You can be on the right side of the trade when the exit doors slam shut. This is why the silent collapse exists, to give you the information they don't want you to have, to show you the moves happening in the shadows, to expose the playbook so you're not blindsided when the next crash comes. Because it's not a matter of if, it's a matter of when. And when it happens, you'll either be positioned correctly or you'll be another victim. I want you to do something right now. Go look at your portfolio. Look at your positions. Ask yourself, honestly, are these investments based on solid fundamentals, or are you chasing momentum? Are you buying what institutions are selling? Are you the exit liquidity? If the answer makes you uncomfortable, it's time to make changes. And here's my final point. The next crash might already be in motion. The distribution phase could be happening right now as you watch this. Every day that passes, more smart money is leaving. Every rally could be a bull trap designed to lure in the last buyers. The clock is ticking, and the institutions have already started their countdown. So here's what I need from you. Drop a comment below and tell me what you're seeing in the markets right now. Are you noticing the same warning signs? Have you adjusted your positions? Share this video with anyone who needs to hear this message. The more people who understand the exit playbook, the fewer victims there will be. And make sure you're subscribed to the Silent Collapse, because we're going to continue tracking these institutional movements and exposing exactly what they're doing before every major move. The game is rigged, but it's not unwinnable. You just have to play it with your eyes open. Watch the smart money, follow their moves, and most importantly, be willing to exit before the crowd. Because when everyone rushes for the door at once, only the people already outside survive. The institutions know this. Now you know it too. The question is, what are you going to do with this knowledge